What's going on, you guys? My name is Zach Hartley, and in this video, we are going to talk about tax loss harvesting. I'm going to walk you through what it is and how it works with an example so that you have everything you need to know. Let's go. Okay, so tax loss harvesting is basically a strategy of locking in your losses to reduce your taxes. Now, it's usually something that people consider and a strategy that people use when they have lost money on a position. And so I'm going to walk you through an example of exactly that. So let's say that before COVID hit, you had bought $10,000 worth of Carnival Cruise Line stock, and now it is down 40%. So you bought in at the beginning of 2020 thinking it's going to be a fantastic year for the cruise lines. COVID hits, and now your position is down 40%. In total, you are down $4,000, but in general and in the long run, you're a long-term investor and you like the stock and you think it will recover. So you now have two different options. The first option that you can do is you can hold on and you can hope that it comes back up. In this scenario, you have absolutely no tax implications until you sell. You can wait it out. Hopefully it comes back to break even. Hopefully it starts to make you some money and you will not have to pay any type of capital gains tax, any type of tax on that holding or on that security until you decide to sell 1 year, 5 year, 10 years from now. You don't have to do anything. And so if you decide to go with option one, you just hold on, you diamond hands it and you wait it out, then there will be absolutely no tax implications for you. You do run the risk of it running lower or the risk of basically it not recovering and you just holding on and basically losing the opportunity to invest in other companies, but this is an option. Now, option number two here is the strategy of tax loss harvesting. And so what we're going to do here is step one would be to sell all of your Carnival Cruise Line shares at that 40% loss. When you sell those shares, you will be locking in that $4,000 loss, and that will be basically a capital loss. Now, what you want to do at this point is because you still like the industry, you still want exposure to the cruise industry, and you think it will recover, what you're going to do is buy a company that is very similar and very close to Carnival Cruise Lines. In our scenario, and in this case, that's probably going to be Royal Caribbean. Let's say you owned Microsoft, you might want to buy Apple. If you own Coke, you might want to buy Pepsi. And the reason that we want to buy a similar company is because that's going to keep our portfolio balanced, that's going to keep our diversity there, and that's going to keep our weightings and our basically industry weightings where we want it. Now, the reason that you're going to buy a company that's very similar is because it's going to move in roughly the same direction. You can see that in red, we have Royal Caribbean, and in blue, we have Carnival Cruise Lines. We own Carnival Cruise Lines going into COVID here, and then as you can see, it drops massively, and now it is starting to recover. But let's say you're in this position right here. What do? Do you hold on and try and hope that it recovers, or do you sell out and you go through this kind of tax loss harvesting? Well, if you go through the tax loss harvesting and you completely sell out of Carnival Cruise Lines and then you buy back in with your $6,000 into Royal Caribbean, this is the scenario that we're in. So you had a capital loss of $4,000 when you sold your shares. Now, on that $4,000 capital loss, you can use 50% of that to reduce your capital gains tax. So capital gains tax is where you get taxed on 50% of your capital gains. It's the exact same thing with a capital loss. You get to write off 50% of your capital loss. And so, for instance, if you live in the US and you have property or you have any type of assets such as stocks that are going to go through capital gains tax this year and have capital gains appreciation where you've locked in some capital gains, you can use your capital loss to offset that capital gain for the amount of 50% of your capital loss. In this scenario, that would be $2,000. And so if you lock in a $4,000 loss, you can then use $2,000 to reduce your capital gains tax. It's kind of like getting 50% of your basically loss back at the end of the year in taxes, which is absolutely amazing. And so in our scenario, we can use 50% of that loss to reduce our capital gains tax by $2,000. That's what I just explained to you. And then by investing our $6,000 in Royal Caribbean, we can keep our portfolio balanced and we get the benefit of the recovery in the industry because we're long-term investors. We think it's going to recover. So if Royal Caribbean recovers from the dip that they saw all the way back up to break even, we get all of that appreciation, but we also got a $2,000 reduction on our capital gains tax at the end of the year. So if Royal Caribbean goes from $6,000 to $10,000, you've got $4,000 worth of capital gains there. You pay taxes on $2,000 worth of that capital gains. And if you had gone through this scenario and you had used tax loss harvesting, it would have wiped that tax payment to absolutely zero, assuming that you had sold those shares at the end of the year. So this is absolutely amazing, and it's a great program, and it's absolutely phenomenal if you are sitting on an absolute loser right now, if you're in the cannabis space and it's not going so well, or you lost money on psychedelics or whatever it is. If you can get out of that position, lock in the capital loss, and then buy a similar company if you still like that space long term, it will allow you to take advantage of that capital loss from a tax perspective, and it will still give you the upside of the industry long term. Now, a couple of things to know about tax loss harvesting. Number one is that you have to have owned the shares for at least 30 days prior to selling them. The other thing is that you cannot buy them back for at least 30 days. That's the reason that we're buying an alternate company that's very similar, is because otherwise you could just lock in the loss and then buy right back into it, and you'd be in the exact same situation with the tax benefit. You can't do that. You have to basically not own it for 30 days after you sell it, and that's the reason that we're buying a similar company, is because that way you still get the exposure, you still get the recovery benefit, but this way you can get that tax benefit as well. Now, you can also apply your capital loss to the previous 3 years of capital gains or to any year in the future. So let's say you just have a massive capital loss this year, you can just keep that, you can bank it, and you can use it towards your capital gains in the future, which is absolutely just an amazing benefit that they give for you. Now, if you're interested in learning a little bit more about this and how to actually figure out where to invest your money and what stocks to choose, then you should definitely consider signing up for my Stock Market Fundamentals course. It is completely free. When you sign up with the link in the description to this video, you get 2 weeks free access to the entire Skillshare platform. That's where you can take my course. You can take any other course as well, but mine has 9 hours of content in it that will walk you through step by step everything you need to know to get started in the market. And there's over 5,900 students that have already gone through the course. There's over 280 reviews, and I promise you, it'll be the best free resource that you can find online. Over 80% of people say it exceeded their expectations, and again, it's completely free. The link is in the description to this video. Now, in summary, tax loss harvesting is the idea of locking in your capital losses to offset your capital gains tax. Basically, when you have a losing position, we're going to lock that in. We're going to count it as a capital loss. We're going to offset our capital gains tax at the end of the year, or we're going to bank it there for the future. And what that's going to do is it's going to reduce the pain and reduce the financial burden that that loss has on our account. So definitely a good thing. But before you go through with any of this, make sure that you consult a professional, or at least do the research in the place where you live. These are the rules for Canada and most of the US, but make sure that you consult a professional and do your own research. And remember to click that like and subscribe button. I sincerely appreciate it. I'm not a financial advisor. I'm not a tax consultant. I'm not a tax anything. I'm just a guy that likes to share what I've learned. And so I hope you get some value out of this, and I'll see you guys in the next video. Good luck trading. Good luck investing. Talk to you soon.